The broader FMCG sector has struggled recently, but in the agro-processing space, one company is suddenly pulling ahead: Cian Agro Industries and Infrastructure. This dual line chart shows exactly how much of an outlier they are. Cian stock has surged a staggering 153.8% over the last year, completely crushing the BSE FMCG index, which is down 10% over the same period. Intrigued? Usually, a run-up like that makes a stock extremely expensive, but look at the text blocks below the trend lines. Cian is trading at a PE ratio of just 17.5 and a price-to-book ratio of 1.4. In today's market, that is a deep discount. The excitement seems justified when you look at their top-line revenue. They've grown sales from 101 crore in 2017 to over 1,029 crore in 2025. Here is the dilemma. When a stock surges 150%, but the market still prices it at a bargain basement valuation, institutional investors are usually pricing in a massive hidden risk. To figure out if this is a value trap or a true opportunity, we have to open the balance sheet. We need to find out if Cian Agro's meteoric rise is sustainable business scaling or a leveraged mirage waiting to trap unsuspecting buyers. Let's start with the positives, because Cian has made genuine improvements on the factory floor. Over the past 5 years, management has successfully optimized processing operations and expanded their product mix. Those operational wins show up directly on the income statement. Operating profit margins have expanded from 8.8% in 2021 to nearly 14.7% today, driving net profits up to over 41 crore. But to see how much of that profit actually benefits you as a shareholder, we have to weigh it against return on equity, or ROE. This metric tells us how effectively management is using your money to generate those earnings. This chart reveals the problem. While the net profit column grows, the ROE line sharply drops, hitting a critically low 2.1%. The reason? Massive equity dilution and a huge buildup of reserves. The denominator is growing much faster than the actual profits. A company can run a highly efficient factory, but if they are diluting equity and hoarding reserves to do it, that operational efficiency doesn't translate into capital efficiency for the shareholder. To understand where all that capital is going, we need to shift from the income statement to the balance sheet and look at the sheer scale of their physical expansion between 2017 and 2025. This area chart tracks total assets. From a modest 70 crore in 2017, it spikes over 8 years, ballooning into a massive 4,184 crore asset mountain. A positive byproduct is operating cash flow jumping to 281 crore, represented by this small base area. However, we must measure the quality of that growth using asset turnover, which shows how efficiently a company uses assets to generate sales. Cian's asset turnover plummeted from 1.44 down to 0.25. They are buying assets faster than they can squeeze revenue out of them. When you hoard assets without efficiently converting them into sales, your overall returns suffer. As a result, CAAN's return on capital employed has dropped to a mere 3.95.
We must distinguish between true growth and brute force size. Cian is buying physical expansion, but right now they are failing to sustainably scale it. This brings us to a critical question. How exactly does a small-cap company finance a sudden multi-thousand crore asset expansion? They borrowed it. This line graph tracks total debt, and it shoots straight up in exact parallel to their assets, rising from 107 crore to 1,297 crore. This debt provided liquidity to fund aggressive acquisitions and support a 152. At 1.72, they are squarely in the very likely danger zone for a solvency crunch if their revenue misses a beat. Management made a clear choice here. They actively traded long-term balance sheet stability for the immediate gratification of short-term debt-fueled size. Now we can revisit that initial hook. On the surface, a PE of 17.6 and a price-to-book ratio of 1.4 looks highly attractive, especially when you compare it to industry peers. For context, competitors like Cian Agro trade at a much higher price-to-book ratio of nearly 5.9. But the market isn't blind. Institutional capital is intentionally leaving Cian in the bargain bin. That cheap price perfectly discounts the immense debt load and the terrible return on assets. This is the classic valuation trap. A stock is only truly cheap if the underlying fundamentals are healthy.
Otherwise, it is simply priced accurately for its elevated risk. Cian Agro presents a clear duality. As this illustration suggests, they have built incredible top-line momentum, but it rests entirely on a precarious foundation of aggressive leverage. So who should actually buy this stock? If you are a conservative value investor seeking safety and stable exposure to the FMCG sector, you need to avoid this. Traditional fundamentalists must pass. The combination of a zero dividend yield, high solvency risk, and poor capital efficiency makes this stock uninvestable for defensive portfolios. However, if you are a high-risk turnaround asset speculator, this deserves your attention. The upside bull case is straightforward. If management can properly digest this 4,000 crore asset base and use their new 280 crore cash flow to aggressively pay down debt, that low price-to-book ratio offers a highly lucrative entry point. To track whether that turnaround is actually happening, there is a single metric you must watch moving forward: the debt-to-cash flow from operations ratio. Over the next 4 quarters, this ratio alone will prove if management is actively handling their leverage or if the debt is becoming toxic. Never confuse aggressive corporate borrowing with sustainable business scaling. Look past the momentum, respect the balance sheet, and trade accordingly.